Hey, welcome everyone to Global Business here on CGTN. I'm Michael Wong in Beijing. The headlines we're tracking for you at this hour. China's retail spending and store traffic both rose in the first half of the year, pointing to resilient consumer demand. Sharp swings in the Republic of Korea's stock market are testing the durability of the country's AI-driven rally. And oil prices surged while Asian stocks fell after renewed tensions between the United States and Iran rattled global markets once more. All right, well, Chinese mainland equities started off the week with losses. The Shanghai Composite Index falling by 2% on the day, while the Shenzhen Component Index dropped nearly 3.5%. We're going to have more on the mainland markets later in the program. But first, a look at how regional markets performed and how Wall Street closed out on Friday. Well, first up, the 2026 World AI Conference and high-level meeting on global AI governance will be held in Shanghai from July 17th to 20th. Chinese President Xi Jinping will attend the opening ceremony and deliver a keynote speech. All right, turning now to China's consumption momentum, where according to the State Information Center, consumer spending at physical stores, well, that rose 2.7% in the first half of the year compared to the same period last year, while foot traffic increased by 5.7%. Now, that growth was fueled by robust demand for electronic devices, tourism-related spending, and dining out. Analysts at the center noted that policy support on both the supply and demand sides has helped to drive the recovery when it comes to offline retail. And China has launched its 2026 summer culture and tourism consumption season. More than 450 million yuan, or about $66 million worth of consumer vouchers will be distributed to boost travel and spending.
A launching event is held at Haibei Tibetan Autonomous Prefecture in northwest China's Qinghai province. Organized by the Ministry of Culture and Tourism, the campaign aims to improve the supply of seasonal tourism products and services and encourage people to enjoy travel during the summer holidays. Running from early July to late August, the campaign is expected to feature more than 30,000 activities nationwide, catering to popular travel demands such as summer gateways, coastal vacations, night tourism, cruise trips, and study tours.
This summer, Qinghai will turn its plateau ecology into a snow mountain travel brand, with over 1,000 cross-sector events, from agriculture to wellness. We're delivering direct travel benefits for a cool, relaxing, one-of-a-kind plateau experience.
This campaign comes as China has set a target of significantly enhancing people's access to tourism by 2030. According to a new 5-year tourism development plan issued on Tuesday. Shen Li, CGTN.
And China's Ministry of Commerce has introduced 15 measures to boost foreign investment. They include support for foreign invested retailers wanting to upgrade to urban commercial districts and launch global debuts. Now, Shanghai has continued attracting international consumer brands supported by its strong business environment, vast consumer market, and well-developed debut economy. A number of flagship first stores focused on community retail, premium skincare, and immersive dining have opened across the city. Foreign brands are deepening their integration into Shanghai's commercial landscape and are driving the renewal of retail spaces and the upgrading of consumer experiences.
Today we're celebrating our first anniversary of Legoland Shanghai. We have passed long already 2 million visitors, which is more than we expected. We are very confident in the future, so we're already planning big investments to move forward. We want to convert even more of that and develop this destination into not just a day trip attraction, but even more become a resort destination where people are coming and staying for 2 or 3 nights in the future.
So Shanghai was the natural choice for our flagship store. Our concept brings together a boutique in the front and a spa in the back. creating seamless experience of retail and professional skincare. And we believe in the immense potential of the Chinese market. The market here is dynamic and highly competitive. It pushes us to elevate our brand and our service. We will continue to invest and bring more professional skincare expertise to the Chinese consumer. Our goal is straightforward: to grow together with the Chinese market for the long term.
Shanghai is definitely the first spot where we wanted to have our own store. We had queues in front of the store, so that means really the Chinese the consumers, or the consumers in Shanghai. So our chocolate classes that we offer every now and then here in our stores have been booked out very fast. Chinese market, I mean, it's such a booming market, such a growing market, an interesting market. The consumers love to experience new things, and we have a long-term commitment to the Chinese market. We'll be definitely present in China and grow with the market and with the Chinese population.
And the momentum of China's inbound tourism continues, driven by the expansion of the visa-free policy to even more countries. To attract travelers seeking deeper cultural experiences, Beijing is rolling out tourism options that combine cutting-edge technology with rich cultural offerings.
Beijing has unveiled its first top 10 new scenarios for inbound tourism, blending trendy shopping, wellness, and high-tech industrial tours with the Tech Meets China chic appeal. More than 300 travel operators from over 40 countries have already sealed deals worth nearly 45 million yuan, both online and offline.
I think it's very changed the China. It's more easy, the entry and the buy connection is very, very easy. Now I buy this present for my family, for my office, and it's very easy. I pay with Weixin. Yes, very convenient.
At a recent event, 17 countries and 30 Chinese provinces showcased local specialties and innovations. Beijing's 798 Art District brought VR cinema experiences, while other regions offered intangible cultural heritage food and one-stop tax refund services.
Beijing has pioneered a citywide one-stop tax refund model, offering immediate refunds upon purchase and cross-regional mutual recognition. We also launched the country's first online duty-free refund store for overseas tourists. We have basically built a three-dimensional tax refund service system covering core business districts, key hotels, bank branches, and international exhibitions.
In the first 5 months, we received over 2.6 million inbound tourists, a year-on-year increase of over 35%, and tourism expenditure exceeded 25 billion yuan. Going forward, we will promote the development of new cultural tourism productivity through public service upgrades, industrial improvements, and market regulation, while advancing the application of technology in cultural tourism scenarios.
Shao Wei, CGTN, Beijing.
All right, turning now to China's energy markets, where for years the city of Chengdu's power grid operated on a single vulnerable circuit. Now that changed this April with the activation of a solid dual loop network designed to secure electricity for a megacity of over 21 million people. We take a closer look now at how this engineering feat keeps the lights on.
Stretching from the Yudi substation, a network of transmission lines now interconnects 15 substations across 2 layered rings, forming Chengdu's 500 kilovolt solid dual-loop grid. As the core hub of the Chengdu-Chongqing economic circle, the city has seen electricity demand surge by over 8% annually for the past 5 years, with peak loads hitting new records each year. Yet Chengdu generates little of its own power. More than 80% must be imported. So how does this new grid meet the massive appetite of a growing metropolis?
The solid dual-loop system serves 3 purposes. It channels incoming power around the city center to balance loads. If one line fails, the other loop reroutes power instantly to prevent blackouts. And it significantly raises the grid's overall capacity, allowing more green energy to flow in. This gives us the headroom to support new districts, industries, and the rapid expansion of renewables.
Designed to mirror Chengdu's own ring-shaped urban expansion, the grid is also equipped with the world's first domestically developed grid-forming static VAR generator. This cutting-edge device can counter sudden voltage swings in milliseconds. Since going live, the system has pushed the downtown area's power reliability to 99.99% and boosted the main grid's safe load capacity to over 25 million kilowatts, a critical buffer for the city's future. The dual-loop system does three things. It channels incoming power around the city center to balance loads. If one line fails, the other loop reroutes power instantly to prevent blackouts. And it significantly raises the grid's overall capacity, allowing more green energy to flow in. This gives us the headroom to support new districts, industries, and the rapid expansion of renewables.
So China is accelerating its clean energy transition with record high power generation and grid expansion. The country now has the world's largest installed power capacity, with renewable energy accounting for more than 60% of the total. At the same time, China is scaling up its west-to-east power transmission project, which ensures a secure power supply nationwide. So far, 24 ultra-high voltage transmission lines are in operation, channeling renewable electricity from resource-rich western provinces to major demand centers here in the east. By 2030, China will add another 15 such transmission lines, boosting the west-to-east power transmission capacity to over 420 gigawatts. Right, so China is indeed transforming what was once isolated clean energy resources into a nationally integrated electricity market that can reach major population centers here, like in Beijing, over in Shanghai, but also all corners of the country. Let's get more on that and bring in Zhang Haoran, Vice Dean at Peking University School of Urban Planning and Design. Dean Zhang, welcome to the program. I want to begin by asking you, because China is further building up what is already the world's largest and most advanced clean energy transmission networks. Also, its ultra-high voltage electricity network now spans more than 60,000 kilometers. For some context for our audience, that's long enough to circle the Earth about 1.5 times. What strategic role do you think will China's ultra-high voltage project play in connecting clean energy resources with the country's major economic centers?
Yeah, I think the role for UHV network projects are very clear. It is a key bridge between China's clean energy in the west and the economic center in the east. Western China is one of the most richest places in China for water, wind, and solar power. But for years, power lines were so limited, so a lot of clean energy could not be sent out and used. And this kind of power will follow to the east regions, China's most important growth engine, and the future to the east. Its factories, tech companies, and the data center all need stable, clean electricity. So I would say the clean energy was always here. Now it can finally reach the places that need it most. Thank you.
Yeah. And Dean Zhang, China aims to invest over 5 trillion yuan over the next 5 years into its power grid. That's around $737 billion at today's market exchange rate. How do you see this massive investment in the power grid reshaping regional economic development? I would assume it would have massive impacts when it comes to upstream all the way to downstream industries.
Yeah. I think this environment will benefit the regional economics twice. It helped once during constructions and again for many years after. 5 trillion yuan is a huge number, but in my view, this is a smart national choices. It supports growth today and builds a stronger energy system for tomorrow. I believe this money does not stay on paper. It comes real orders, real jobs, and real growth. Take Abba project as an example. During construction, the demand goes to 3 areas. First, steel. A line over 700 kilometers along needs huge amounts of steel for its towers. Second, equipment. Factories across China produce the cables and the transformers. Third, construction itself. Thousands of workers build the projects. The business along the road all get a boost. Then comes to the second benefit, which I believe lasts much longer. Places like Abba can turn their rivers, wind, and the sunshine into steady income year after year. I think for the mountain regions in the west, that is a real path for lasting development. Thank you so much.
Dean Zhang, let me ask you about China's clean energy future, because the country, of course, has a number of clean energy targets and also carbon targets. So by 2030, China aims to peak carbon emissions. By 2060, China aims to achieve carbon neutrality. By 2060 as well, China aims to achieve over 80% non-fossil energy consumption. So more broadly, what role will China's expanding ultra-high voltage transmission network play in terms of accelerating the country's transition to a lower carbon future and to meet its carbon neutrality goal?
Yeah, my view is simple. I think without a stronger power network, there is no low carbon future. The UHV network is a backbone of China energy transition. Look at where China stands. Our total power capacity has passed 4 billion kilowatts, and the largest in the world. And the share of non-fossil energy is moving toward 16%. I believe this shows one thing clearly. Green development is the direction of the Chinese future. But I think here is a key. Most of the Chinese clean energy is in the west, while most of the demand is in the east. Clean power only cuts carbon when it actually reaches factories, data centers, and home. This is exactly what the UHV network does. In my view, the logic is clear. Every unit green power sent to the east means light coal burn. Look at one project up to the 13.5 billion kilowatt hour of green power can follow east every year. That's 6 million of the tons of coal. And within 15 more UHV lines planned, the effect will keep going. So I believe every new line brings China one step closer to the carbon neutrality. This is the road China will keep working. Thank you.
Okay, many thanks for your insights on all of that. That's Zhang Haoran, Vice Dean at Peking University School of Urban Planning and Design. All right, we are going to take a short break. Up next here on Global Business. Sharp swings in the Republic of Korea stock market are putting the AI-driven rally under pressure.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, sharp, and insightful. Global Business. Only on CGTN.
All right, let's get to China's capital markets now, where the issuance of Panda bonds, which are renminbi-denominated bonds issued by overseas entities here on the Chinese mainland, have surged more than 70% so far this year to 170 billion yuan. That's around 25 billion US dollars. Now, analysts say favorable interest rate spreads, flexible use of proceeds, and streamlined issuance procedures have been driving up the popularity of Panda bonds. New issuers this year include countries such as Slovenia, Pakistan, and Kazakhstan, as well as global financial institutions such as French banking giant BNP Paribas. Brazil is set to become the first Latin American country to issue Panda bonds after filing for approval in late June. Now, Panda bonds issuance is expected to hit an all-time high by the end of this year. While China's futures and security sectors posted robust first-half results. Fresh data from the China Futures Association showed total futures trading volume surging over 25% year-on-year to 5 billion lots, while turnover jumped 42% to nearly 483 trillion yuan in the first 6 months. In June alone, futures turnover skyrocketed 53% to around 81 trillion yuan. Industry officials noted the market's strong resilience, with 167 futures and options products now actively traded across key economic sectors. Meanwhile, at least 10 listed securities firms have forecast significant profit growth for the first half of this year, signaling a broad-based strength in China's capital markets. All right, let's get a closer look now at the equity markets here on the Chinese mainland, over in Hong Kong and Tokyo. Tim Pope is standing by for us in Shanghai. Tim, good to see you. So the Chinese mainland markets today dipping again. What was the story over in Shanghai and Shenzhen?
Hi there, Michael. It wasn't just Shanghai and Shenzhen. Markets around Asia fell today as the US and Iran traded strikes, adding to doubts about the interim agreement that they signed just a few weeks ago. The Shanghai Composite Index was down more than 2%. The Shenzhen component was off by 3.5%. The market was already taking profits on tech stocks, and the latest Middle East developments have added to the uncertainty and made a return to a sustained rally look a little bit unlikely for the moment. The Shanghai Composite Index is already looking a little bit range-bound around 4,000 points. The AI and semiconductor sectors were among the hardest hit today. Sub-indexes tracking each sector down 3% or more today. Defence, satellite and rare earth stocks also traded lower. The only real bright side was for energy and financial stocks. Oil prices, of course, jumped in the wake of the latest developments in the Middle East, leading to a 4.2% gain for PetroChina shares. And the big banks were up as well. For the week ahead, the markets are going to be waiting on a lot of big-ticket Chinese economic data. The second quarter GDP numbers will be out midweek. Ahead of that, we should also see the trade data, which is expected to continue pretty strong, and fixed asset investment and retail sales data as well, which have been fairly soft recently and will be closely watched for whether or not things there are improving, Michael.
Right. So indeed, Tim, how about the other regional markets? How hard were they hit? How are they doing today?
Well, Hong Kong's Hang Seng managed to look fairly resilient by regional standards today, kept keeping its head above water. It ended the day a whisker higher, but we saw some really heavy falls for South Korea's Kospi, in particular the Kospi 200, down almost 10%, and some strong falls in Tokyo too, which I'll come to in just a moment. Energy, industrials and consumer stocks did a lot of the heavy lifting for the Hang Seng in Hong Kong today, while we saw tech stocks dragging, and that was the story around the region, really. Recent index edition Minimax tanked by 17% to close at a record low. Its shares have been falling since a huge chunk of outstanding shares came out of post-IPO lockup last week. But today, the AI company stock sank below its market debut price for the first time. Minimax, though, of course, just one of the companies which contributed to a truly stellar first half of the year for Hong Kong Stock Exchange's IPO sheet. 85 new listings. They raised more than 210 billion Hong Kong dollars. That was a gain of 92% year on year. And the outlook for the rest of the year is pretty strong too. The IPO pipeline is full of AI, semiconductor and robotics companies, among others. Over in Tokyo today, the Nikkei 225, as I said, was down 1.9%. Worries about rising oil prices really added to the tension there. There's worries that that's going to fuel company cost rises. Investors seemed a little bit more sensitive to that today as we head into financial reporting season in Japan. AI chain-related stocks retreated again. The heavyweights Tokyo Electron and Advantest were dragging on the Nikkei. There were also some gains, though, for financial and banking stocks, suggesting that perhaps investors are rotating out of AI shares for the moment. On the earnings front, robotics company Yaskawa Electric was a standout. Its shares were down more than 14% today after it reported a 21.7% slump in first quarter net profits. Japanese and other regional stock investors, though, will be looking to the US this week as well as reporting season gets underway there. And we're going to be seeing some of the big investment banks among the first to release their results. But otherwise, Michael, a busy and bleak-looking Monday around the region.
Indeed. Okay, Tim, many thanks for that update as always. Tim Pope for us in Shanghai. Right, so the Republic of Korea's stock market has been on a roller coaster of a ride recently. In the first half of this year, the Kospi stock index emerged as the best performing index in the world, surging over 100% on the AI supercycle. The current rally began last October when Samsung Electronics and SK Hynix joined OpenAI's $500 billion Stargate project to supply memory chips. The two memory giants, which control over half the global market, surged on investor optimism over the AI boom. Together, they drove nearly 90% of the Kospi's first half gains. The index hit 7,000 for the first time on May 6th, broke 8,000 just 9 days later, and topped 9,000 on June 18th before stalling. But the index has become highly volatile right now, heavily dependent on just two stocks, which account for a staggering 56% of the Kospi. The swings have alarmed policymakers who are mulling curbs on single stock ETF leverage in order to rein in volatility. Right, so the Republic of Korea's main equity benchmark, the Kospi, has gone from one of the world's hottest to one of its most volatile in just a matter of weeks. Let's get more on this and bring in Chen Jiahe, Chief Investment Officer at Novum RK Technologies. Jiahe, so the Kospi has experienced unusually sharp swings, I would say, since the end of June. Are these signs, you think, of temporary volatility, or do they reflect deeper risks facing the Republic of Korea's AI-driven markets?
Well, as a stock investor, my personal judgment toward this extreme volatility is actually quite pessimistic. It can be a sign which shows the super bull market in the South Korean stock market is about to end, because when we look at the Kospi index and the stock market behind it, they have been rising by a few times in the past 13 to 14 months' time. This is a super bull market. You don't usually see such a rising in stock markets. I mean, the overall market has increased by a few hundred percentage points in just a bit over 1 year's time. And if we look at the valuation of this market, it is not cheap anymore. The PE ratio might be low, but the PB ratio is definitely not low. This is because the major companies such as Samsung and SK Hynix are making extraordinary profit in a super bull semiconductor market. Meanwhile, if we look at the investors, many retail investors are using a huge amount of leverage, which is also very dangerous. So this sharp swing that we have seen in the past few trading days is actually quite dangerous in my point of view.
Yeah, well, Jiahe, the AI boom has pushed a number of memory chip makers to record levels of profitability. You see this for ROK chip makers, for U.S. chip makers as well. You see operating margins ranging anywhere from 60% all the way to 80%. How sustainable are these extraordinary margins, and what would need to happen, you think, for them to remain at today's levels?
Yes, this is a key of the problem, that the profitability of these major companies of the stock market is basically unsustainable. When we look at the financial statements of these companies, such as Samsung, SK Hynix, we can see that they are reporting super amount of profit that was never made in the past many years. And the support behind this happy story, unfortunately, is not sustainable. It's because AI companies all over the world, especially in the United States, are giving a very high demand toward these semiconductor companies. And because these companies are having the world's largest production power and the demand comes so quick, so they raised the price of their products and made an extraordinary profit. But this is not a profit that will be sustained in the long term. Once the boom of AI technologies is cooling down, the demand will be much less and the profit of these companies will drop to a normal status. But the problem is that the market today is not preparing for that. The market is pushing the prices of these companies to a level that reflect a very optimistic situation, which is not possible. So this is quite a worrisome situation.
Right. So I think few major economies, Jiahe, are as closely tied to the fortunes of a single industry as the ROK is to semiconductors. Does this concentration, you think, then create a competitive advantage long term for the Republic of Korea? Because after all, we are calling this an AI supercycle. Or do you think it's more of a vulnerability on net if the AI boom does indeed begin to lose steam?
Well, this is a very good question, and I think the answer is yes to both of them. For small economies such as Korea, they can't be spreading their industries like China has been doing. I mean, China has 1.4 billion people, which is almost 1/5 of the world. That means China is large enough to develop almost every industry because China has enough support of labor for these industries and a super large domestic market to provide the demand for many industries. But for smaller economies that has millions or tens of millions of people, if they work the way that China has been doing, they will lose competitive advantage in this global market because they are too small to support so many industries. But if they concentrate their industrial developments, they will face problems once the industry is having a lot of turbulence, like the AI is doing. I think in order to sort this problem out, there is a very good solution for these small economies. That is, alongside developing the domestic industries and markets, they have to actively invest in other economies around the world. That means when they can concentrate with their own industrial competitive advantage, they can also get benefits by investing in the good companies in other economies. With this, Singapore is showing a very good example. They made quite good investment all over the world, a large part of which is in China. And this investment is strongly backing up the domestic economy.
Okay, we're going to leave it there. Jia He, always great to get your insights. That's Chen Jiahe, Chief Investment Officer at Novum RK Technologies. And still to come here on Global Business. Oil prices surged while Asian stocks fell after renewed tensions between the U.S. and Iran rattles global markets.
A vast land of 1.4 billion people. The world's second largest economy. Home to stories of the unexpected, the unimaginable, the breathtaking. Stories that touch the soul. Feel the speed, the passion. Enjoy spectacular natural and cultural landscapes. Feel the thrill of cutting-edge innovations. Discovering China. Global Biz. China Travel. We present the China never seen before. 24/7 at your fingertips.
Oil prices surged more than 4% on Monday as energy shipments through the Strait of Hormuz came under renewed threat following, of course, fresh announcements of military strikes by both the U.S. and Iran. Shortly after the market opened, Brent crude futures rose over 4%, with prices returning to nearly $79 a barrel and briefly approaching the $80 mark at the session high. Meanwhile, U.S. West Texas Intermediate crude also jumped more than 4%, breaking above $74 a barrel. According to Iran's state news agency IRNA, Tehran has declared the Strait of Hormuz closed. The waterway serves as a critical lifeline for global oil flows, and the move has sharply intensified market anxiety over potential supply disruptions. To North American trade now, where for more than 3 decades, free trade has transformed the U.S.-Mexico border into one of the world's busiest commercial corridors. But after the U.S. decided not to renew the USMCA trade pact, businesses and workers who rely on cross-border commerce are bracing for an uncertain future. CGTN's Alistair Baverstock has more.
Eagle Pass, Texas, where bridges across the Rio Grande see a constant flow of trucks in both directions between Mexico and the United States. These neighbouring countries are mutual top trade partners, but US President Donald Trump's announcement that he will not renew the USMCA free trade agreement has sent shockwaves through this region of North America.
Behind me, hundreds of trucks cross this border every day, carrying goods worth annual sums in the billions of dollars. But the Trump administration's refusal to renew USMCA has left those trade volumes, as well as the jobs they support here in Eagle Pass, facing an uncertain future.
In downtown Eagle Pass, an area already struggling with decreased tourism volumes from across the river, the news has many locals concerned.
I don't know what's going to happen. Like me as a small business owner, I'm trying to do more things. Hopefully, we don't come to another recession. Hopefully. But how I see everything is like if you are in a desert. Everything's so calm in the business way.
It's not only local businesses that fear the end of 32 years of free trade. Goods travelling between these countries overwhelmingly move on 18 wheels, and truckers like Julio Garcia are set to be impacted by decreased volumes.
Yeah, we kind of worry a lot about that. It's not good because it's gonna lower our jobs. And I live in the border town, so we got a lot of commercial trucks coming from Mexico to Laredo. It's gonna be bad.
Economists warn any reduction in cross-border trade would be felt first in communities like Eagle Pass, where local economies depend on the daily movement of goods across the Rio Grande.
This is going to affect a lot if they close the market. We need open markets. We need a global. We need better proposals. Something that we need to get together and just talk about it. It can get better.
The US decision not to renew USMCA doesn't abruptly end the pact, instead triggering a sunset clause that mandates yearly reviews for another 10 years. While the community here remains nervous, that period is giving people to hope that a new deal guaranteeing free trade will ultimately emerge. Alistair Baberstock, CGTN, Eagle Pass, Texas.
And a quick look now at other business headlines we are tracking at this hour. The Republic of Korea has reported a near 50% increase in exports this year, led by semiconductors, shipbuilding orders, and fossil fuel products. Data from the U.S. Federal Reserve shows the outstanding consumer debt in the U.S. fell over $180 million in May, marking the first credit card spending decline in almost 2 years. And the organizers of the Tour de France shortened a stage of the race by 30 kilometers on Sunday. That's after France's weather authority issued a red heat wave alert for the racing area. Well, Germany is facing a concerning population challenge, with fewer babies being born than at almost any other time in the past 7 decades. And this is fueling concerns over labor shortages and the growing cost of supporting an aging population. And while governments have introduced measures to encourage people to have children, many young adults say the decision is shaped by far more than economics, as our Natalie Carney reports.
30-year-old therapist Oriane has chosen not to have kids. She wants to concentrate on her career and says years of unhealthy relationships, inherited family trauma, and the current state of the world have all influenced her decision about parenthood. And she's not alone.
From what I hear from friends who also don't want children, they just don't have the time. It's too expensive, which that's also one of my concerns. If I look at how much money you have to spend on a child, I don't think I can afford it at the moment. I could never afford the lifestyle I had with my parents. A lot of people I know who decided to not have children said the world is too scary right now. Why would I want to bring a child into this world?
650,000 babies were born in Germany last year, the lowest number since 1946, bringing the fertility rate to 1.32 children per woman.
We're
seeing short-term and long-term developments which contribute to low birth rates. For example, there are uncertainties due to economic stagnation in Germany, inflation and a shortage of affordable housing. The prospects for the future are also saddened by increasingly noticeable climate change and the effects of demographic change on social security systems.
These factors are leading women to reject motherhood or delay pregnancy until their late 30s and 40s, which then increases potential fertility issues. As Germany grapples with one of Europe's fastest aging populations, fewer babies today means fewer workers tomorrow, putting pressure on everything from the economy to healthcare and pensions.
It is to be expected that the heavily populated baby boomers will of course need more help with increased aging. More people will be in need of care. The problematic development is therefore predetermined. Less people will be able to pay into social and healthcare systems and provide the care work on the one hand, and on the other hand, the number of those who are dependent on such support will increase.
Without higher birth rates or sustained immigration, Germany's population and economy is projected to shrink significantly over the coming decades. To try and fill the labor gaps in all sectors, Germany is increasingly looking abroad and easing immigration rules in a bid to attract skilled workers. At the same time, Berlin has also announced tax relief for families and higher monthly child benefits with reduced bureaucracy. But many say these financial incentives still aren't enough to override such significant personal decisions.
I don't want to have children, and it does make me feel very anxious. I just never had that motherly instinct or these feelings of I want my own children. I just never really have that, so I don't really need them. It's a mixture of different things.
Germany's historically low birth rate is likely to have profound implications on the country. Yet behind the statistics are deeply personal decisions influenced by changing values, economic realities, and individual circumstances. However, that does leave Germany facing difficult questions about how the country can adapt to a very different demographic future. Natalie Carney for CGTN in Munich.
And that's going to wrap up this edition of Global Business here on CGTN. I'm Michael Wong here in Beijing. Stay tuned. The World Today is coming up next with Li Chuyuan.